All right, let's talk about something that honestly keeps a lot of traders up at night. Why do so many people fail at this? But more importantly, we're going to flip that around and talk about how you can be one of the ones who actually succeeds. And the answer is built on a framework that's, well, it's as simple as learning your ABCs.
It really all kicks off with this one number. And look, you've probably seen it thrown around before. It's a really tough pill to swallow. 99%.
Yep, you heard that right. The vast majority of people who try trading, they just don't make it. And, it's a stat that scares a ton of people off. And honestly, for good reason.
So why? What is going on here? What's the secret sauce that the other 1% has? Is it, some kind of magic entry strategy? Or maybe some secret risk management formula nobody knows about? I mean, people spend years chasing this stuff thinking that's the key.
But the truth? It's actually refreshingly simple. Our source for this explainer puts it this way. The number one reason traders fail, it's because they just don't know how to read the market. That's it. They can't tell which way the current is flowing. So forget all those complex strategies for a second. This is about getting back to basics, understanding the simple language of the charts.
Okay, so how do we learn to read them then? Well, it all starts with this idea called top-down analysis. And look, this isn't just another strategy. Think of it as the absolute non-negotiable starting point for ever seeing the market with any kind of clarity.
So what is it really? At its core, top-down analysis is just the skill of figuring out the market's overall direction. You start with a massive, big-picture view. We're talking the highest time frames, and then you slowly zoom into the little details on the lower ones. It's kind of like looking at a map, right? You'd want to see the whole country first before you try to navigate a single street in some tiny town. And I gotta say it again, this really isn't some complex graduate-level idea. The source material calls it the ABCs of trading, and for a very good reason. I mean, think about it. You can't write a novel if you don't know the alphabet, right? Well, it's the same thing here. You just can't trade successfully if you don't get the market's direction. It really is that foundational.
Okay, here's another great way to think about it that makes this super clear. Imagine the market is a giant highway. Now, it doesn't matter what you're driving. Maybe you're a scalper zipping around on a motorcycle, a day trader in a car, or a swing trader in a big rig. Everyone, and I mean everyone, has to follow the same basic rule. You drive in the direction of the traffic. Top-down analysis is just you figuring out which way that traffic is flowing.
All right, so we get what it is and why it's so important. But the big question is, how do we actually do it? Well, let's put on our hard hats and think like an architect building a skyscraper. This framework is going to make it all click.
To build this market view, you're going to focus on 3 key time frames. First up is the weekly. This is your foundation, the solid ground that holds the whole thing up. A strong foundation means you can build a taller building, right? Then you move to the daily time frame. These are like the big, strong cement blocks that form the actual walls of your analysis. And finally, you get to the 4-hour time frame. This is the concrete that you pour in to fill all the gaps, adding strength and making your view really firm. When you get all 3 of these pointing in the same direction, man, your analysis is going to be rock solid.
And remember this, it's like a golden rule. The higher the time frame, the stronger the signal. It's just simple logic. I mean, think about it. It takes 7 full days of action, of buying and selling, to form just one single weekly candle. So of course that signal carries way more weight than a little candle that forms in, say, 15 minutes. Okay, so you've got the architect's framework. Awesome. Now it's time to actually learn how to read the blueprints, the chart itself. To do that, we need to spot something called market structure. And a really cool way to think about this is that it's like listening to the market's heartbeat.
So what is market structure? It's just the series of high points and low points that the price makes as it moves. That's it. And that heartbeat of the market analogy, it's perfect. Because just like an EKG in a hospital, it leaves this trail, this rhythm that tells you everything you need to know about the market's health and, most importantly, which direction it's headed.
Now, the cool thing is this heartbeat can only really be in one of 2 states. It's either bullish, that's an uptrend, and what you'll see is a series of higher highs and higher lows, or it's bearish, a downtrend where you'll see a series of lower lows and lower highs. That's literally it. Super, super simple. So what does a healthy, bullish heartbeat actually look like on the chart? It means the market is consistently making new highs. It's pushing up. The peaks on our little EKG just keep getting higher and higher, and that's your signal. It tells you the market is strong, it's healthy, and it's definitely trending up. And you guessed it, a bearish heartbeat is just the total opposite. Now the market is consistently making new lows. The valleys on that EKG are getting lower and lower. All the pressure is pushing down. The heartbeat is clearly trending down.
Okay, let's bring this all together. What's the big takeaway here? After you do all this and you understand the market's direction, what now? Well, it boils down to one very simple choice. Are you going to trade with the trend, or are you going to try to fight it? You've all heard that old saying, right? The trend is your friend. And man, it's a classic for a reason. This quote from our source just says it perfectly. Your job is not to create the trend, and it's not to break the trend. Your only job is to figure out what it is and trade with it, because that is where all the good, high-probability setups are hiding.
And let's really drive this point home with these analogies, because they're powerful. Trading with the trend, that's pro-trend. It's like swimming with the current, or driving down the highway with both hands firmly on the wheel. It feels controlled, it's safe, it's high probability. But trading against the trend? Well, that's like drifting around a corner with just one hand on the wheel. Or, get this, trying to stop a rising bullet. It's just pure, high-risk gambling, and it is not a path to long-term success. No way.
You know, this really needs a total shift in your mindset. Your goal is not to be some kind of hero who perfectly calls the exact top or the exact bottom. No, your job is to be more like a detective. You identify the overall direction, and then you just join the move that's already happening. Let the market do all the heavy lifting for you.
So there you have it. That's the framework. You now have the fundamental tool you need to read the market's heartbeat. So the very next time you pull up a chart, I want you to ask yourself this one simple question. What is the market telling me right now?